If you've ever made business decisions without knowing your numbers, this episode is for you. I've got two stories that we're going to go through today where we have one business owner that's gotten themselves into a high interest loan, and we're going to talk about how to better plan for that. And the other story is about a business owner that already had the loan that he wanted, but he was paying it off so fast, he didn't realize how quickly he was using up all his working capital. Most small business owners don't fail because of a lack of passion. They fail because they're running blind. I'm Mark Anderson, and I help small business owners make data-driven decisions using the information from their accounting records. My mission is simple. I want to make a dent in the small business failure rate by teaching you how to use your finances to make better decisions. Welcome to Business on the Run. About 4 years ago, we picked up a new client that was in the oilfield services business. One of the things that he was experiencing was difficulty getting traditional loans. So what he ended up doing was going to a high interest lender, basically continually repeating this process. He'd pay it off for a while and then refinance the loan, and then back through the cycle again we went. Unfortunately, it's a cycle that's continued to this day. We've run into this issue where he doesn't want to heed our advice in terms of better positioning himself for the long term. It's always a microwave type perspective. We want it now. We need to do this now, instead of being more long range and planning. And that's where knowing your numbers is really beneficial. Ideally, what I'd love to see for this client is that we work more closely together with respect to how we can position him and his business where he can go to a traditional lender and get the interest rates to come way, way down. And all of that just simply goes straight to the bottom line as profits. And there are a number of factors that are working into this. One of them is personal in nature. His personal credit is questionable. I strongly believe that you don't really have compartments in your life. Whether we're talking about faith or business or personal or your marriage, all of this comes together and coalesces in some way, shape, or form. If you can think of a Venn diagram where there's always some intersection, and you have certain areas of that Venn diagram that are independent of one another, that's the way that this looks. But his personal life is bleeding into the business life, causing him to have issues on the business. And that strain has caused higher interest rates and higher borrowing costs. With some proper planning and guidance in that situation, the first thing that we would want to look at there is improving the personal situation, whether that is reducing personal credit card debt or bringing down loan liabilities on vehicles. It's long range. It's going to take time to adjust for. That's the other thing that I think that many small business owners don't think about is, where do I want to take the business and how do I get it there? It helps to have a long-term financial picture of what that looks like. So it's important to have that balance sheet now, but also, what do I want it to look like in the future? And take the necessary actions. Making your balance sheet look more attractive in the future, it's going to be like turning around an aircraft carrier. It is going to take time and effort, but with steady progress, making the right moves, just one or two moves every single month, you can make a massive difference in turning that balance sheet around to something that you can actually take to a bank. I can tell you this from personal experience, that if I didn't have the personal credit that I had when I started my business, I wouldn't have been able to open it the way that I did. This gentleman was kind of behind the eight ball when he started the business. So now he's got to work on the personal side as well as the business side. This brings me back a little bit to when I was a golf professional. One of the biggest complaints that I had when I was a golf professional is going out, teaching a lesson, and coming back the next week and say, how did everything go last week with your practices and your playing and all of that? And the response would be, I haven't done a single thing. That last time I saw you was right here, or the last time I touched a golf club was right here with you on the driving range. And that doesn't do any good. You've got to make the moves. You've got to take action in order to see a difference in your business, in your credit history, and in your life. That is the picture that I'd like to see for him, but you can't lead a horse to water and make them drink. So that's just one of the obstacles that we deal with respect to helping small business owners sometimes. Here's the way that I like to look at a balance sheet. There's obviously an accounting definition, and I hate talking accounting definitions and all of that stuff. It's speak that the typical small business owner doesn't really understand or like. While I think it's important that they learn some of that jargon for their own purposes, talking to tax professionals, lenders, other small business owners, whatever the case may be, it is important. I like to view the balance sheet from a small business perspective as being two-sided. On one side of the equal sign, if you will, think of it as an equation. You've got assets equals liabilities plus equity. Let's flip that just a little bit. On the asset side of the equal sign, you really have everything that is physical, tangible and intangible things, if you will, that make up the business. The space that you're operating from, all of the equipment that you may be using for that business. And then on the other side of the equal sign, you've got how all of those things are being funded. You've got liabilities, loans, that can help fund what you're doing with the other side of the equal, on the other side of the equal sign, all of the tangible and intangible things. You've also got equity, where that's the business owner putting his skin in the game to participate in the business as well. So you've got the tangible and intangible on one side, and then you've got the funding sources on the other. Let's say you've got $100 worth of assets on one side, but your liabilities on the other side, a funding source, you've funded that $100 with $120. You've got more liabilities on the wrong side of the equal sign there. And that means that you must have negative 20 on the equity side. So you're actually in the hole as a business owner. In the example that we were talking about earlier in terms of righting that ship, we've got to figure out how to do one of a few different things. You've got three levers there, right? You've got assets, you've got liabilities, and you've got equity, right? We want to do what we can to drive the assets up. That's one lever, right? So what are we going to do there? We can do things like saving costs, right? Maybe we're spending too much money on advertising that is not bringing in the clients that we need. Maybe we're spending way too much money on wining and dining ourselves or our team or whatever, and we're using up our resources on the asset side too much. The other side is on the liabilities. One of the things that we could do is decrease liabilities. I am all for using debt effectively and efficiently to expand the business, but if debt is being used wastefully, that can be catastrophic for business owners. So the other thing there is going to be to try to reduce the debt load. With that much debt, odds are your interest expense is going to be through the roof. And then on the other side is you want your equity to be greater. If we can get equity up, that means assets will go up as well, and could mean the owner putting more money into the business. That's not something I would necessarily want to do, because that means you're taking money out personally that you'd have to throw into the business. I like to look at it from the asset side to generate more sales, increase revenues, and decrease costs, become more profitable. And there are ways that you can figure out how to do that. That kind of thing. If you can only one or two more sales in that first month, that may not seem like very much in the beginning, but if you can do that every single month, and then it's going to add up and accumulate. And when I say that's what it's like to turn around that aircraft carrier, that's what I'm talking about. It may seem like you're making no progress at all in the first month or two that you're doing it. By the time you get to month 12, 13, 15, 18, 20, 24, now you have a balance sheet. If you've been steady with those moves all along, you've got a balance sheet that hopefully you can go to the bank and say, I want a loan. I've got a profitable business here. I want to grow and expand and scale. And they're going to be much more amenable to speaking with you about it because you have a solid balance sheet. Because the one thing that they're looking for if you're going to borrow money is how is that bank going to get paid back the money that you borrow. That's what they're most concerned with. Again, looking at that equation a little bit for it's the accounting equation, the fundamental accounting equation, assets equals liabilities plus equity, but it's also the equation for your balance sheet. One of the math equations that they're going to look at most of the time is what percentage of equity does the owner have relative to assets? If that number is already small, meaning somewhere below 40 or even 30%, then the bank is in all likelihood not going to look at lending you money. If that number is, and I'm talking post-loan here, pre-loan, they're going to, before you borrow the money, right, your equity stake needs to be probably 40, 50, 60% before you get the loan. So when we talked earlier about there being $20, negative $20, that is a $70 shift in equity to now be positioned for a loan. So you can see why it takes so long to get there. As an example, with this particular client, the only services that he's requested of us is to maintain the accounting and the bookkeeping and the financial reporting. What he has not enrolled us to do is really the more CFO level types of services. And I'll give you an example, and I'll use our business as an example. We have a few metrics that we look at that are leading indicators of success. When used properly, those leading indicators can help you manage the future, if you will. The numbers that we look at, because I went through similar situations, just slightly different scenario, is one of the biggest drivers of our business is billable hours. When the higher our billable hours are, typically the more revenue and gross profit we are making. That's not always the case. I've got another metric that helps us to determine profitability as well, and that's realization. And what realization is if and again, using $100 as an example, if I bill $100 and I charge $100, I've realized $100. I'm less profitable if my realization number goes down. I've billed $100 for work, but now I can only collect on 80 for one reason or another. Maybe I made a mistake and I need to give a discount because I made a mistake. It happens from time to time, and that's just the way the ball bounces from sometimes. Well, now I may have hit my $100 goal, but I didn't hit my realization goal. I want to hit 100%. I want to collect every dollar that I earn. But in this case, that went down. So those are a couple of metrics that we look at throughout the course of the entire month. And when I'm looking at those, I love looking at those every single day because I can tell very early on in the month whether or not I'm going to hit my numbers for my business. Within literally a couple $1,000s, I know what my business is going to look like. What we do is very recurring in nature. For this oilfield services client, it's a similar situation. We would just look at some different metrics because no business is created equally, right? And that's what is so important about the KPIs or the leading indicators, if you will. You've got to custom design them for each business. So for oilfield services, that number may be rigs sold or the products that they're selling, right? It could be the Christmas trees that are being built. When I say Christmas tree, it's the rigging that goes on the oil field. So that could be one metric. There could be another with respect to labor, like labor realization rates or labor utilization rates. Those are just some examples. And if those are being watched throughout the month, you can know what your numbers are going to be at the end. Let's flip the script just a little bit and talk about, well, what do you do when your numbers aren't hitting? Well, that could happen, but if you're looking at them and monitoring them every single day and you're like, oh, wait a minute, you know what? So-and-so is behind on their billable hours. I better figure out what's going on. They may have taken a vacation. Now, that's obviously going to mess things up a little bit, but let's say that for one reason or another, they're not billing all of their time to the clients the way that they should. I don't know what the reasoning behind it is, but it's something to investigate. When you look into it and you're like, I had things to do, I needed to do, I just couldn't, I didn't get all of my billable hours in. For one reason or another, I had too many administrative tasks that I had to handle. That's going to be something you're like, well, okay, this is where you have that CTJ moment, the come to Jesus call, right? Where it's like, now you need to hit these numbers. You can, if you've done it early enough, if you're monitoring these numbers, you can now adjust on the fly so that they can make up that time before the month comes up. My team they're very well aware of their numbers, so they're looking at this stuff as closely as I am, at least I've trained them to. Those are just some of the examples that we would use to help small business owners monitor their activities so that they know what income statement, what their financial results, the financial performance is going to be at the end of the month. And it takes a little bit of discipline. It takes some design on the front end to make that happen. Doing that month in, month out over time, you will eventually have a balance sheet that will be working for you instead of against you. 5-6 years ago, probably picked this client up. And at the time, one of the things that I love about if our clients are taking advantage of the financial package that we offer, they get a graphical representation over time of what their balance sheet looks like. And I love this graphical representation because when you look at it over a trend, it really is a very, very telling thing. A couple of things with respect to this client that I have in mind, and let's just say that they are in the services industry for medical services. They also had a fairly sizable loan that the SBA provided on the front end to help them build out the space they were in, also to fill it with the equipment that they needed and even staff up. At the time, their assets, or their liabilities rather, were greater than their assets. So it was fun to see the progression for this particular client because they went from being in a deficit to being at zero, and then just basically continuing to see this trend go up, 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 and up. But along the way, what we discovered is a networking capital issue. I should define what that means before we go any further. Networking capital is essentially the assets that you have on the books that will be utilized in 12 months. It could be cash. It could be receivables that are due from clients. It could be prepaid insurance or expenses of some sort. Those are examples of prepaid assets. On the liability side, it's everything that would be due within that 12-month period. Those are the obligations. In the beginning, he had a very large working capital balance that was really, he was well suited. But one of the things that drove this particular small business owner crazy was all of the interest that was getting paid to the bank for the interest on this great big loan. Over time, what we noticed on his chart, again, a report that we have on our financial package, is also the net working capital. So that net amount between the current assets and the current liabilities was declining. Let me just do an example of what net working capital might look like in a single period. If you've got $100 worth of current assets and you have $80 worth of liabilities, you've got $20 in working capital. Fairly simple math there, so that's not terribly complex. But the one thing that number doesn't tell you is what's the trend? What's the trend? So with this particular owner, let's say that they had $80,000 worth of working capital on the books. That's fantastic, meaning that they've clearly got way more current assets than current liabilities. I qualify that a little because as I think about that, they may not, if they don't have any current assets at all or current liabilities, they could still have a high current assets number that would mean working capital is pretty high. In this case, they did have a fair amount of current liabilities, but still had plenty of current assets to cover that balance. So anyway, in our reporting package, we have this graph of the net working capital, and his was starting at about $80,000. But what I noticed over time was that number would start getting more and more rapidly declining. And the reason that when I dug into why that was happening, what I discovered was he was making massive payments towards the loan. So he was using up his cash a whole lot faster than it was coming in simply to pay off the loan. So the advice that I gave was, hey, I don't know if you've noticed this trend or not, but I want to point it out to you. You're using up your cash probably a lot more quickly than you realize. And what he ended up doing, this is the opposite example of my golf example earlier, a student that actually took my advice and he practiced during the weeks between our lessons. And what he did was he still made extra principal payments, but at a much, much slower rate. He probably cut it back by about 80%, the principal payments. So now he started to turn that curve around where instead of this rapid decline, that curve started to bend back up again and his cash balance started to go back up. He's taking advantage of extra principal payments to lessen that interest expense over time, but he was also positioning himself for any of the short-term pitfalls that may come along the way, like COVID as an example. I lost a number of clients from COVID because they weren't prepared for those eventualities that put a lot of small business owners out of business. In this case, our client came out on top because they ended up having the working capital that they needed to actually open another location. So it was a good outcome for them. So I gave you a couple of really interesting examples, kind of a failure story and a success story, but both of those stories really stress the importance of a number of things. Getting to know some of the accounting jargon that is out there, that is going to benefit you as well as the people that you are dealing with. And just one quick example, that person that's trying to get that loan that they want, do you think you will be better off being the small business owner that knows what working capital is going into the lender, or having to resort to the lender telling you what working capital is? Quick question, do with it what you may. And then on the flip side, we've got the positive story where the client actually heeded our advice in terms of slowing the rate of repayment on his SBA loans to better position himself. And it really also, it goes to a great example of the difference between good debt and bad debt. This small business owner would not have been able to open his first store and then eventually the second store without debt. So we'll talk about that in the future, about what the difference between good debt and bad debt. That would be a really great topic to speak on. All of this goes to the importance of knowing what your numbers are, having good KPIs so that you can manage your balance sheet in such a way that you can turn that aircraft carrier around, that balance sheet around, so that you can position it in such a way that now you've become an attractive potential lendee, if you will, or a borrower. And then also just knowing how to read and understand your financial statements overall. That's really what Know Your Numbers is all about. With that, I will conclude. And if there is anything that you guys would like for me to talk about in a future episode, please let me know. And please be sure to subscribe to our podcast. Thank you very much for listening and watching to Business on the Run with Mark Anderson. In our show notes, we'll have all of our social channels so that you can connect with us there. Please be sure to put in the comments anything that you have questions about. I will reply. If you want more information about our firm, the link to the website is in the show notes. And with that, I hope you guys have a fantastic day.